Before the sun came up over Calgary, the war had already begun. They didn't bring banners. They brought bank drafts, trade-ins, printed out pre-approvals. And they lined up, not for a Black Friday deal, but for the opening move in what might be the most dangerous power shift the auto industry has ever seen. Inside, dealership staff weren't selling. They were surviving. The point-of-sale system crashed twice before noon. Toyota's new EV wasn't just selling, it was erasing the competition. And that's exactly how they designed it. While Tesla fans were busy arguing over software updates, Toyota launched a full-scale market ambush, with backup from Chinese battery giants and quiet backing from Canadian policymakers. It wasn't just a car, it was a corporate warhead with cup holders. So now the questions become, what just hit the US market? Why is Elon Musk cornered? And how does a quiet Canadian city become the front line of a global economic assault? Watch closely. You're already inside the blast radius, a Trojan horse in dealership lots. The parking lot outside Calgary's flagship Toyota dealership was already half full before sunrise. Most of the people in line weren't even customers yet. They were watchers, holding spreadsheets, trade-in offers, and saved down payment checks. Inside, Sarah Chen stood with her sales team, all staring at the inventory screens blinking red. Orders were flying in faster than their point-of-sale system could refresh. "We've never seen interest like this," she said, half excited, half overwhelmed. What sparked the frenzy was not a celebrity endorsement, a new trim package, or even a Super Bowl ad. It was something far more disruptive. Toyota had launched an electric vehicle priced so low and packed with so many features that it didn't just attract new buyers, it sparked panic buying. Some dealerships across Alberta saw their pre-orders jump by over 200% overnight. This wasn't a fluke. The buzz rippling across showrooms in Calgary, Edmonton, and Red Deer was the result of a deliberate strategy engineered thousands of miles away. Toyota had just deployed a Trojan Horse into North America's electric vehicle market, and no one, not even Tesla, seemed ready for what was coming next. Billions lost, calculated gain. From inside Toyota's Tokyo boardroom, the tone was far more sober. The rollout wasn't about buzz, it was about bloodshed. A recently leaked memo, reviewed by a former Tesla chief financial officer, now turned private consultant, revealed the company expected to lose over $3 billion in its first year from this model alone. But it wasn't considered a loss. It was considered an opening move in what executives were already calling strategic containment. They had studied the Trump administration's first term and the renewed America First strategy. The playbook was familiar. Lose short-term margins to dominate long-term markets. They're waging economic warfare, the consultant said in a private email chain to investors. This is what you do when you want to break your enemy's pricing power. And they're treating Tesla like a hostile target. Dealers might have been thrilled, but investors weren't. On Wall Street, the phrase margin sacrifice started trending in EV circles. The prevailing fear wasn't whether Toyota would make money. It was what Tesla would have to give up to defend its ground. And inside that war chest was a weapon Tesla couldn't match. Ultra-cheap batteries that rewrote the rules of the EV game. Inside the budget beast. In Wuhan, at the heart of Toyota's joint operations with GAC, rows of lithium iron phosphate battery packs slid through conveyor belts under sterile lights. The floors were spotless. The air was ionized. There was no drama, just pure volume. "We churn out 100,000 cells weekly," said the shift supervisor, a woman who had been with the plant since the beginning of its LFP conversion. "It's all about scale and reliability." The key advantage wasn't just cost, it was predictability. We sifted through battery supply chains, leaked investor memos, and dealership rollout data to show you how Toyota flipped the game. You're not just getting headlines, you're getting the full playbook. If that saved you time or gave you an edge, hit subscribe. LFP cells don't require cobalt. They don't demand exotic metals locked behind geopolitical deals. Most importantly, they cost roughly 40% less per kilowatt hour compared to the cells Tesla builds in Nevada. Toyota wasn't just undercutting price, it was slicing from a supply chain that Tesla no longer had exclusive control over. Each cell that rolled off the line fed a broader system: infotainment units, heat pumps, panel gaps adjusted by robot arms with military precision. The result was a vehicle that felt premium, but cost like a bargain. And while American customers marveled at the price, Toyota's engineers were already several iterations ahead, preparing second-generation platforms that would bring costs down even further. The day premium pricing died. By the time the New York Stock Exchange opened the next morning, everything had changed. Tesla's share price began dropping the moment Toyota's North American press release hit the wire. 5%, 15 minutes. That's how fast the mood shifted. Inside a Manhattan trading firm, one desk trader threw down his headset and muttered, "I'm calling for a margin call meeting." His colleague didn't even look up. "Never bet against Toyota," he replied. The tone wasn't panicked, but it was deeply, unmistakably tense. Tesla's value proposition had always been its margin. That margin was built on brand, exclusivity, and a vertically integrated supply chain that delivered sleek, luxurious vehicles at scale. But what happens when a rival offers similar quality for $10,000 less? What happens when that rival's parts are more affordable, their maintenance plans more accessible, and their supply chain more stable? Ford and General Motors were watching all this unfold with dread. Internally, both automakers had begun scheduling emergency war room sessions. Not to outmatch Toyota's engineering, that wasn't realistic in the short term, but to revise their pricing strategies before their dealer networks revolted. Unlike Tesla, Ford and GM still depended on dealers for survival, and those dealers were already asking an uncomfortable question: if Toyota can build this so cheap, why can't we? As the ripples spread across the market, it became clear this wasn't a product launch. It was an offensive. And it wasn't just aimed at Tesla, it was aimed at the pricing logic of the entire electric vehicle sector. The initial strike was over. Now came the countermeasures: margin squeeze and buyer's remorse. The screenshots began flooding social media one by one, each carrying the same message: regret. Across European forums and encrypted Discord servers, Tesla owners were starting to crack. One viral post from a German driver named Lucas read, "I locked in at 50, and now they're listing at 42. His post received over 2,000 replies in under 24 hours. Q2 cancellations in Germany alone rose by 23%. Most weren't due to mechanical issues, but psychological ones. People felt tricked. They had bought at the peak, believing the brand would hold its value, only to watch Toyota undercut it with a more feature-rich car. Loan-to-value ratios collapsed. Trade-in values plummeted. Enthusiasts who once evangelized the Tesla brand were now questioning why their cars felt like tech stocks instead of transportation. Inside Tesla's European Operations Center, executives debated whether to initiate a mid-year price drop. The math was brutal. Every 10% cut erased hundreds of millions in projected revenue. Yet the alternative, doing nothing, risked eroding trust even faster. One director summed it up best in a closed-door meeting: "We can't afford loyalty if it's built on resentment." Tesla wasn't just losing sales, it was losing confidence. And in the electric vehicle space, confidence is currency. Without it, the empire begins to wobble. Factory empire fractures. In Fremont, California, technicians worked overtime to reconfigure production lines that were never designed for affordability. Musk's promise of vertical integration had always been Tesla's strength, but now it was the company's greatest bottleneck. To make a cheaper car, Tesla needed new chassis frames, different battery modules, and simpler electronics. That meant retooling, and retooling meant downtime. The estimated cost to retrofit Fremont's core assembly line topped $200 million United States dollars. The estimated delay? 6 months. Floor manager Maria watched as her team navigated the stop-start rhythm of an emergency design pivot. "Downtime kills momentum," she warned a visiting executive. "We're barely holding speed." Every lost week gave Toyota a bigger lead. Worse, it exposed a deeper problem. Tesla's supply chain wasn't as nimble as it once claimed. The very thing that gave them speed and efficiency was now anchoring them to old designs. Retooling their factories meant pausing production on higher-margin models. That risked compounding revenue losses just as shareholders were demanding acceleration. Tesla tried running 2 design tracks in parallel, one for existing premium builds and another for budget iterations. The result was chaos. Engineers scrambled to prototype bodywork that could accommodate cheaper batteries. Marketing teams delayed campaign launches by weeks. And somewhere in the middle of it all, Musk himself called for a high-level strategy shift. He wasn't the only one scrambling. The competition wasn't just catching up, they were rewriting the rules of access. And those rules extended far beyond factory floors. The crumbling moat. Outside Ottawa, under Prime Minister Mark Carney's clean energy push, a quiet revolution had been unfolding. The number of electric vehicle charging stations equipped with combined charging system ports had grown by over 80% in just 6 months. The message from Canadian regulators was clear. Open systems would lead, closed ecosystems would be sidelined. For Tesla, whose proprietary supercharger network was once its moat, this was a direct threat. Across rural Ontario, Tesla owners were plugging into government-backed stations with zero friction. One charging station installer described the shift bluntly. "They plug in here now. No supercharger needed." That independence changed buyer psychology. Drivers no longer felt tethered to the Tesla ecosystem. If they could buy an electric vehicle that charged anywhere, had faster service, and cost less up front, why stick with the one brand that forced them into exclusivity? Meanwhile, Canadian policy analysts under Carney's administration were already sketching long-term grid plans around interoperability. No more single-brand choke points, no more proprietary barriers, just scalable access for everyone. What was once Tesla's greatest strength had quietly turned into a liability. Dealers noticed. And they weren't going to wait quietly. Dealerships strike back. In Manitoba, a local dealership technician leaned against a rolling toolbox and pointed toward a row of electric vehicles awaiting inspection. "We fix it same day," he said with a grin. Compared to Tesla's service wait time of 5 weeks, Toyota's 3-day average turnaround had become a competitive weapon. Tesla had centralized everything: software updates, diagnostics, repair queues. That approach worked when the company was small and its vehicles were rare. But now, it meant delays, frustrated customers, and a growing chorus of complaints. Toyota, by contrast, had spent years quietly training thousands of technicians through its existing dealer network. Retired mechanics who once worked on gasoline engines were now certified in electric drivetrains. Parts were stocked regionally. Repair tools were standardized. The result was a level of local support Tesla couldn't match, at least not without a complete overhaul of its strategy. The gap wasn't just logistical, it was cultural. Tesla had sold a vision of independence from dealerships. But in the wake of Toyota's rise, customers were starting to see value in having a local team they could talk to face-to-face. "We know their names," said one technician. "We see them every oil change or battery update now." Back at Tesla's headquarters, executives watched these developments with increasing anxiety. The battle for hearts and minds was no longer just about specs or price. It was about trust, convenience, and community. Tesla once owned all three. Now its competitors were reclaiming each, one test drive at a time. BYD's Home Field Challenge. Inside BYD's Research and Development Center in Shenzhen, urgency hummed louder than the machinery. Engineers clustered around pricing models, trying to do the impossible: match Toyota's aggressive pricing without bleeding themselves dry. The challenge wasn't innovation, it was sustainability. Toyota had weaponized scale, and even in China, that move sent shockwaves. Last quarter, BYD sold over 3 million new energy vehicles across its home market, commanding nearly 40% of total market share. That dominance had been hard-earned. Yet now it felt precarious. Executive Wei Liu paced behind a screen showing Toyota's newest joint venture numbers. "We're in a price war now," he told his team. "Margins will evaporate if we chase them down." Internally, BYD debated whether to compete directly or shift focus to upper segments. Some argued that defending the low-cost throne was a strategic trap. Others feared ceding too much ground to an old rival newly armed with modern tactics. What none could ignore was the sheer efficiency Toyota had unlocked by partnering with GAC. Outside, the landscape was shifting. In the distance, across oceans and continents, another old giant was waking up and stumbling. Volkswagen's bureaucratic quicksand. At Volkswagen headquarters in Wolfsburg, meetings never ended. A single change to the ID.4's user interface had passed through 12 internal approval committees. 9 months had gone by, and the final product still hadn't shipped. One frustrated engineer muttered under his breath, "One more signature and we'd still be drafting next quarter." Inside Berlin and Brussels, policymakers met with corporate leaders to discuss streamlining regulations, but the weight of legacy systems bore down like concrete. As Toyota and BYD raced ahead, Volkswagen tripped on paperwork. The electric vehicle revolution was moving at the speed of software, and Volkswagen was still built on the rhythm of internal combustion bureaucracy. In a conference room draped with European Union flags, an exhausted commissioner admitted the truth. "Speed kills bureaucracy," he said, "and we are getting killed." To make matters worse, every delay widened the gap. Consumers in key markets like the United States and Canada were choosing brands that could iterate and deliver fast. Volkswagen was stuck in a self-inflicted traffic jam. That stagnation opened a door, and behind it stood an alliance no Western executive had seen coming. At least not like this. The Japan-China EV alliance rocks the West. When news leaked of Toyota and GAC's enhanced joint venture capacity, panic spread through think tanks in Washington. A classified briefing circulated among energy analysts, spelling out a chilling projection. By the end of 2026, the alliance could manufacture 2 million electric vehicles per year without needing a single part from the United States. That alliance wasn't just strategic, it was surgical. By consolidating battery production, software development, and final assembly under one transnational roof, Toyota had insulated itself from Western tariffs, supply shocks, and political leverage. Suddenly, calls to impose Buy North tariffs echoed through Canadian Parliament. Trade Minister Diane Wood, serving under Prime Minister Mark Carney, addressed the House with barely disguised urgency. "We need our own champion," she declared, "or we risk becoming a buyer, not a builder." The rhetoric caught on fast. Headlines across Canada and the United States speculated on the end of American electric vehicle dominance. Suddenly, the question was not just who could make the best car, but who could still afford to build one at scale. And while politicians debated legislation, average families ran the numbers. What they discovered changed everything. Gasoline just got a death sentence. In Halifax, Nova Scotia, the Gillis family did something revolutionary. They sat down with a calculator. Their gas-powered compact car had served them well, but rising maintenance costs and pump prices were pushing them toward a tipping point. When they compared costs over 10 years, the numbers were staggering. Electric vehicles, even after installation of a home charger, averaged about 12 cents per mile. Their gasoline vehicle cost 25 cents per mile. That difference translated to over 3,000 United States dollars in annual savings for a family commuting daily. It wasn't a hard sell after that. The father, a modest municipal worker, said it simply, "That seals it. We go electric." Multiply that decision across thousands of households, and you get a silent revolution. Not one driven by ideology or trendiness, but pure economic logic. Gasoline vehicles were becoming a luxury, and an impractical one at that. The implications reached beyond families. Business owners were watching. Their decisions were next. Fleet frenzy. Businesses flip. At the Toronto headquarters of a rapidly expanding rideshare network, dispatch manager Carla Rivera stood before a digital dashboard lit up with route metrics, fleet analytics, and energy consumption reports. Just 2 years prior, they had struggled with ballooning fuel costs, unreliable sedans, and maintenance delays that pushed their bottom line into the red. Now, things had changed drastically. Across their Ontario operations, the company had fully transitioned to Toyota's newest line of electric vehicles, built in joint partnership with Guangzhou Automobile Group. These weren't just eco-friendly statements, they were profit machines. Thanks to solid-state battery reliability, simplified drivetrain maintenance, and impressive charge cycles, total cost of ownership had plummeted by 45%. And perhaps most importantly, rideshare downtime dropped by nearly a full day per week per vehicle. That boost in availability translated directly into revenue. The company hit its break-even target 6 months ahead of projections. Shareholders were ecstatic. Regional competitors scrambled to catch up. Carla summed it up succinctly. "It's a no-brainer for us. We're not making a political move. We're making a business one." The ripple effect extended beyond Toronto. From logistics firms in Calgary to local delivery startups in Montreal, businesses across sectors were undergoing rapid electrification. What began as a scattered trickle of adoption had turned into a tidal wave. Maintenance costs fell. Insurance premiums adjusted in favor of EVs. Financing became easier with rising resale stability, all of which sent shockwaves directly to policymakers. In government offices from Edmonton to Ottawa, the success of these private transitions set off alarm bells. Why? Because the very incentives designed to jumpstart EV adoption were now being devoured at unprecedented speed, and governments simply could not keep up. The EV incentive backfire. In the Canadian Parliament under Mark Carney's administration, a reckoning unfolded. The EV subsidies program, long a flagship policy under Carney's Green Transition Plan, was spiraling out of control. Originally intended to drive early adoption, the rebates had worked too well. Uptake in 2025 had more than doubled from the previous year. Treasury officials were stunned. By the third quarter, nearly 80% of the available funds had already been dispersed. Emergency hearings were convened. Finance and Energy Committee members reviewed grim forecasts. At current rates, they would burn through the next fiscal year's EV rebate budget by spring. A pivot was necessary, and fast. Carney's team announced a sweeping change. 500 million Canadian dollars would be diverted from consumer purchase incentives and instead allocated toward strengthening Canada's power grid. The language was clear. Rebates were yesterday's playbook, declared Chloe Bennett, a rising member of Parliament and one of the youngest voices in the Energy Caucus. "We need infrastructure, not handouts." The new plan focused on accelerating transformer replacements, building redundancy in rural grids, and increasing fast-charging access in underserved regions. Urban planners cheered the shift. Energy officials nodded in agreement, but consumers, they were less thrilled. Homeowners waiting to buy their first EV found the rebates gone. Those who had delayed purchase to time the market lost out. Protest threads lit up social media platforms. In Edmonton, buyers camped overnight outside dealerships, hoping to beat the rebate cutoff. Meanwhile, provinces with stronger grid investments like British Columbia and Quebec found themselves suddenly ahead. Regions that lagged behind would now pay for their procrastination, not just in dollars, but in blackouts. Ownership, resale, and the grid gamble. In Leduc, Alberta, electrical engineer Thomas Yates watched nervously as crews bolted down the last panel on a high-capacity substation transformer. The temperature had dropped below -10, and the sun was barely peeking over the horizon. Peak hours loomed. Yates wasn't just chasing power flow, he was racing against failure. As more residents embraced EVs, evening charging surges had overwhelmed local infrastructure. Just last week, 3 blocks lost power after concurrent charging triggered a cascading transformer trip. "Every 5th house on this grid owns an electric vehicle now," Yates explained. "We're building like mad, but we're still behind." The numbers told a stark story. Since 2023, evening peak demand had surged by 50% in suburban zones across Alberta. Local cooperatives, once modestly funded and sleepy, now faced the logistical nightmare of replacing infrastructure originally built during the 1970s. At the same time, the used vehicle market began tilting. EV resale values rose, buoyed by tax credits and lower operating costs. Gasoline-powered cars began to depreciate faster, especially in urban centers with growing EV infrastructure. Dealers quietly adjusted trade-in formulas, insurers slashed premiums on newer electric fleets, and repair shops. They began to close. Many couldn't afford the diagnostic tools or retraining needed to work on high-voltage systems. In Winnipeg, a 15-year-old family garage shut its doors after 3 straight quarters of EV-driven business decline. The combustion ecosystem, once dominant, was fading. Across the boardroom tables of energy utilities and automakers alike, one question came up again and again. How much longer could Tesla afford to wait? Elon's biggest test. Inside a Tesla boardroom in Palo Alto, a tension unlike any quarterly review settled over the executive team. The conference table was lined with reports, revenue models, and competitive benchmarking spreadsheets. A live feed from the Miami Analyst Summit played on the room's side screen. Market commentators were already framing this moment as Tesla's Rubicon. Elon Musk sat at the head of the table, flanked by key advisors and investor relations officers. The decision at hand was brutal. Cut vehicle prices by 10% and potentially lose over $500 million United States dollars in quarterly revenue. Or hold firm in risk market erosion at a moment when Toyota and BYD were flooding the globe with ultra-affordable electric vehicles. Musk's expression was unreadable. He listened carefully as his top strategist leaned in. "We either bleed margins or bleed brand," the advisor said gravely. A younger executive chimed in. "Our resale values are dropping in Germany. Loyalty programs aren't sticking in Quebec. And in Ontario, Toyota just opened 3 new EV service hubs." Back in Miami, one analyst offered a damning summary. Tesla's exclusivity model was their strength. But the market has changed. Now people want access, not prestige. When the earnings call went live, Elon's voice was calm, measured. "We are evaluating all strategic options," he said. But internally, decisions were already being made. As the call ended, the livestream comments section exploded. Die-hard fans demanded innovation. Shareholders demanded profit protection. Consumers simply asked, "Why is Toyota making a better EV at half the price?" A quiet shift had turned into a revolution. The world was watching, and so was history. So now the dust has settled. Or has it? With Toyota rewriting the rules, Tesla cornered by its own legacy, and global governments redrawing trade lines in real time, we have to ask, is this the beginning of a smarter electric future? Or the collapse of everything we thought we knew about mobility, innovation, and power? Where do you stand? Is Elon Musk still the face of progress? Or has Toyota just stolen the crown? Let us know in the comments. We read everyone.